American old money families built dynasties on railroads, oil, and city land. Their vast fortunes rarely vanished in epic collapse. Instead, most were quietly fractured by mathematics. When a $10 million fortune is evenly split across generations, what remains is a shadow of its former power. Yet the real old money lie is not about spectacular loss, but steady, invisible erosion. The hidden arithmetic that unravels legacies begins long before taxes or upheaval ever arrive. In the decades after the Civil War, a handful of American fortunes took root on a scale never seen before. Railroads stitched the continent together, and with each mile of track, Cornelius Vanderbilt extended his reach, turning the New York Central into a symbol of industrial dominance. In Manhattan, John Jacob Astor quietly acquired parcels of land, transforming fur trading profits into a real estate empire that would define the city's skyline for generations. Oil became the lifeblood of modern industry, and John D. Rockefeller's Standard Oil grew to control nearly every drop in the nation. His wealth was once estimated at 2% of the entire United States economy. Meanwhile, in the growing towns of the Midwest, W.K. Kellogg built a fortune on breakfast cereal, harnessing the rise of consumer goods to reach millions of American tables. These fortunes did not arise from chance or inheritance alone. Each dynasty was built on ownership of land, of resources, of the infrastructure that powered a new industrial age. At their height, the combined wealth of the richest families ran into the billions, measured in Gilded Age dollars. Yet, the foundations of these dynasties rested not just on grand ambition, but on the very structure of their assets. Land could be carved up, stocks could be split, and companies could be divided among heirs. The arithmetic of division was set in motion from the very beginning, shaping the future of every fortune. No matter how vast, a fortune of $10 million, divided equally among 3 children, leaves each with just over $3 million. When those 3 heirs pass their shares to 3 children apiece, the original sum is sliced into 9 parts, and each grandchild inherits roughly $370,000. This is before accounting for the hidden costs that quietly erode these fortunes. Probate, the legal process of settling an estate, often claims 10% at each transfer. Maintenance on sprawling mansions, farmland, or city blocks draws down another 2 to 4% of asset value annually, including staff wages, repairs and taxes, and insurance. Over 30 years, these expenses can drain a quarter to a third of the original wealth, even without market losses or taxes. By the time the 3rd generation arrives, the arithmetic is undeniable. A single $10 million estate, after 2 rounds of division and routine expenses, leaves each great-grandchild with a fraction of the founder's legacy. The process is mechanical, not dramatic. No single event erases the fortune. Instead, the steady logic of equal division, fees, and upkeep ensures that most old money fades long before external forces ever come into play. Federal intervention into private fortunes began to accelerate in the early 20th century. In 1913, the 16th Amendment authorized a federal income tax, introducing a new and permanent drain on inherited wealth. The Revenue Act of 1916 went further, establishing the first national estate tax. For the first time, significant portions of large estates would be claimed by the government at each generational transfer, with top rates quickly rising to 25% during World War I. Antitrust enforcement gained momentum at the same time. The Sherman Act of 1890 had outlawed monopolies, but it was not until the Supreme Court's 1911 decision that Standard Oil was ordered to break apart, dividing Rockefeller's empire into dozens of separate companies. The Clayton Act of 1914 reinforced these efforts, targeting the consolidation of power that had defined the Gilded Age. These policies did not erase fortunes overnight, but they set in motion a steady outflow. Taxes and regulation forced families to liquidate assets, diversify holdings, and adapt to new rules, hastening the process of wealth dispersion. That arithmetic alone had already begun. The fortunes built on railroads, real estate, and oil faced threats beyond the reach of tax codes and inheritance law. Wars and economic upheavals could erase decades of accumulation in a matter of years. During the Great Depression, asset values tumbled across the board. Railroad stocks that once underpinned the Vanderbilt estate lost more than half their worth between 1929 and 1932. Urban real estate, the backbone of the Astor legacy, plummeted as cities struggled with unemployment and falling rents. After World War II, inflation surged, diminishing the real value of cash holdings and fixed income assets. Technological progress added another layer of uncertainty. The rise of petroleum left railroad empires stranded, and new industries shifted demand away from old monopolies. Families who failed to adapt found their fortunes stranded in obsolete sectors, unable to generate the liquidity needed to weather sudden downturns. These shocks did not just reduce numbers on a ledger. They forced sales of family heirlooms, liquidation of land, and, in some cases, the quiet disappearance of once famous names from the ranks of the wealthy. Facing unpredictable markets and mounting outside pressures, many old money families turned to new strategies to preserve what remained. Diversification became a common response. Rail fortunes moved into utilities and banking, while real estate profits funded insurance companies and manufacturing ventures. These shifts were not simply about chasing returns. They reflected a growing recognition that no single asset class could withstand the changing tides of regulation, taxation, and technology. To manage increasingly complex holdings, private family offices emerged. These entities centralized investment decisions, coordinated legal affairs, and oversaw everything from property management to charitable giving. Unlike traditional trusts that focused on distributing income, family offices aimed to sustain collective control across generations. Alongside these, private foundations offered a way to channel wealth into public causes, often with significant tax advantages. Foundations established by families such as the Rockefellers and the Kellogg's institutionalized family influence, turning private fortunes into engines for education, science, and health. Yet, even the most sophisticated governance structures could only slow the steady unraveling. The professionalization of wealth management brought new expertise, but it also signaled a shift away from the personal stewardship that once defined these dynasties. By the 1920s, the great houses of America's elite stood as monuments to a fading era. Marble halls and gilded ballrooms that once hosted extravagant gatherings began to feel out of step with the times. After the First World War, the social climate shifted. Displaying immense personal wealth became less a mark of success and more a source of discomfort. Etiquette guides and society columns praised restraint over opulence, and the children of old dynasties quietly retreated from public display. Many grand residences, too costly to maintain and no longer suited to the mood of the age, found new lives as museums, hotels, or schools. The Biltmore estate opened its doors to visitors. The Astor Library became part of the New York Public Library. As the impulse to preserve a family's name through architecture faded, the focus turned instead to legacy built through enduring institutions and quiet philanthropy. While family fortunes faded, the institutions, seeded by old money, often eclipsed their founders. The Rockefeller Foundation was established in 1913 with an endowment of $100 million, about $3.1 billion in today's terms. It now manages more than $6 billion in assets, funding scientific research and public health on a global scale. The Astor Library's original bequest of $500,000 in 1854, worth $17 million today, became the cornerstone of the New York Public Library, whose annual budget now surpasses $450 million. Vanderbilt University, launched with a $1 million gift in 1873, now holds an endowment exceeding $10 billion. The W.K. Kellogg Foundation, formed in 1930, grew from a single family's cereal profits into a philanthropic fund with assets over $8 billion. In each case, The institution's financial reach now dwarfs the private wealth that created it, leaving a public legacy that endures long after the fortunes themselves have scattered. Today, more than $84 trillion is set to change hands in the largest wealth transfers in United States history. Inheritance still shapes who owns opportunity and who does not. The slow erosion of fortunes is no relic. It is a pattern reshaping the future. The true legacy is who gets left behind.